Hello friends, this is my 30th presentation for the team of Finance and Accounts, and the subject is 31 causes that can adversely impact the financial reporting of current investment in the balance sheet. Overall, this is my 69th presentation considering all YouTube presentations that I made so far on the subject of ethics in all industries. What I plan to include in this presentation are an overview of 31 clauses that can adversely impact the reporting of current investments in the balance sheet, then highlights of the features of the 6 types of current investments, and listing of causes that can adversely impact their reporting in the balance sheet from the operational and ethical perspectives. These are type 1 fixed assets, type 2 treasury bills of the RBI, type 3 is unit scheme of mutual funds, ICDs of 3 to 6 month duration, commercial papers, and bill discounting by the sellers of its credit sales. Now, shares and bonds. These are publicly traded, and there are corporate bonds also from private sector that can be traded in the secondary market. They also qualify as current investment under the current assets in the balance sheet, provided they meet the certain conditions that related to the number one, liquidity. These investments are intended to be held for a short period, usually less than 12 months. Then they qualify. The company should have the intention and ability to sell them within this short period of time frame. Marketability. The shares and bonds should be readily marketable and convertible into cash. Then they qualify. Similarly, ready forwards or repos. These do qualify as current investment as the maturity period is very short, ranging from overnight to a few weeks, and easily marketable. But since these are in the context of transaction amongst banks, bank to bank, etc., or RBI to bank, etc., the focus of this presentation is current investment in the case of industries, and hence both these two kind of current investments, that is share and bonds and ready forwards, are not included in my presentation. This is an overview of 6 types of current investments, and as you can see from this table, uh, in the second column I have given the name of the current investments, and the column number 3 is the operational causes, and column number 4 is ethical causes. So there are overall 17 operational causes and 14 ethical causes. For example, in the fixed deposits, there are 3 operational causes and 3 ethical causes. Treasury bills of RBI, 2 operational causes and ethical causes, 2 ethical causes, and so on and so forth. This and the listing of causes I will be sharing in my subsequent slides. Fixed deposits, type 1. Now, what type of FDs can be included in this as current investment? FDs with a maturity period of less than or equal to 12 months from the balance sheet date qualify as current investments under the current assets. FDs can be issued either by the banks or by the NBFCs or the companies. Operational causes that can adversely impact reporting of the FDs in the balance sheet. Number 1 is misclassification, that is classifying FDs with maturity date more than 12 months as current investments. This can lead to incorrect reporting in the balance sheet. Valuation errors, overstating the valuation of the investment in the FDs by not recognizing the impairment losses due to the credit risk of the FD issuing bank or the company, usually the company. So in case the FD issued by a company suffers impairment loss and that is not reflected, so this can cause error in the reporting, adverse impact on the reporting. Third is inaccurate disclosures, incorrect disclosure on the maturity or profile of the FDs. Ethical causes that can adversely impact reporting of the FDs in the balance sheet. Fictitious FDs, creating fake FDs records to inflate the company's cash position or manipulate financial ratios. Undisclosed restrictions, not disclosing the restrictions such as lock-in periods. Intentional misuse, investing the FD close to a balance sheet date and withdrawing them shortly thereafter. So these are the 3 operational causes and 3 ethical causes which can cause reverse reporting in the balance sheet. Now let's talk about the treasury bills, or called T-bills. Treasury bills are issued by the RBI in India and are short-term debt instruments. RBI auctions all these T-bills. T-bills can be considered as liquid short-term investments because they are suitable for classification as current assets and on a company's balance sheet. These can also be called marketable securities of the Government of India. Features: the interest earned on these treasury bills is not explicitly paid as a coupon like traditional bonds, but is gained through the discount at which these are issued or auctioned. These T bills are typically issued are redeemable at face value at a maturity, say 91 days treasury bills or 133 day treasury bills or 64 days treasury bills, as per the RBI policy. Continuing with the features of the treasury bills, the interest on the treasury bills is not explicitly paid as coupon like traditional bonds, but is gained through the discount at which they are issued. Already shared that, and these are redeemable at face value with a maturity of 91 days or 182 days or 364 days. Yield computation. The formula to compute the yields in percentage is face value minus the purchase price divided by the purchase price, say a 365, say let's say this is equal to a 3 multiply by 365 days divided by days of maturity, say B. So yield is equal to A multiplied by B. So let me repeat that. First we compute A. What is A? Is face value minus the purchase price divided by purchase price. So let's say that comes out to be A. Then let's compute B. B is 365 divided by the days of maturity. So say B. So percentage yield will be A multiplied by B into 100. This I'll just explain through an example. So let's say for a 91-day treasury bill at a discount of say 1.5%, the yield will be 6.13% as computed below. So in this case, the A is equal to face value say 100 minus purchase price say 98.5 divided by purchase price 98.5. So answer is A is equal to 0.0153. B is equal to 365 divided by say days of maturity 91, say is equal to 4.011. So percentage yield is equal to 0.0153 multiplied by 4.011 into 100, which is equal to 6.13%. It's very simple. Operational causes that can adversely impact reporting of T-bills. Inaccurate disclosure related to the face value, discounting rate and maturity period and the transaction fees, if any, and inaccurate percentage yield computation. Ethical issues are 2. Fake records of the T-bill holdings, and incorrect value of the amount invested in the T-bills. Units basically of the MF, mutual funds. These types of units are highly liquid and can be categorized as current investment in the balance sheet as per the examples below. For example, liquid funds MF, these are short-term money market instruments with maturity up to 91 days. In the Indian context, examples are HDFC liquid fund and SBI liquid fund. Number 2 type is money market funds. These are also highly liquid short-term instruments such as treasury bills of RBI, certificate of deposits, commercial papers. Examples are Kotak Money Market Fund and Axis Money Market Fund. So what I am saying is the second column indicates where money is invested out of these funds. Ultra short-term deposits are debt securities with a maturity of 3 to 6 months. Examples are IDFC short-term fund and DSP ultra short fund. Overnight funds. Here the money is invested in the securities that mature within a 1 day or overnight, and the examples are SBI overnight funds and HDFC overnight funds. So there are 4 types of units of schemes of MF which can be deemed as current investments. How units of MF work amongst the investors and the fund managers? There are 7 steps. It is important to explain these steps so that we can work out what can go wrong in reporting in the balance sheet, either operationally or ethically. So here the investors give money to funds managers to buy units of MF. Funds manager pool this money received from various investors and allocate units to investors based on the amount and the current NAV, net asset value of the fund. Fund managers then invest the pool funds in a diversified portfolio of assets such as money market instruments or short-term debt instrument, which I have just shared. Let me go back. I have shared this where money is invested. So fund managers will invest this in either of these, rather any four of these options. So that was point number 3. Fund managers investing the pooled funds. Then investors earn return based on the performance of the underlying assets in the portfolio, where interest is earned from the portfolio investment in money market instruments or short-term debt securities, etc. Point number 5 is that redemption of redemption by the investors. Being highly liquid, investors can redeem this at any time, and the proceeds are typically credited to the investor within 1 or 2 days, business days. And upon redemption, investors then may incur at times, depending on the choice of the fund, investors may incur exit loss or taxes based on the holding period. Valuation, the NAV, net asset value of the mutual fund, is updated daily basis on the market value of the underlying assets. Type 3 units of MF continuing. Operational causes that can cause adverse impact. Number 1 is inaccurate disclosures, insufficient or incorrect disclosures regarding the type, issuer, and the total invested amount of the units. Misclassification, including those types of unit schemes that don't meet the criteria of the liquid period. And valuation errors, using outdated NAV or neglecting transaction fees. Ethical issues related to the units are including fake units of MF as investment, not disclosing the purchase agreements, if any, and not following the accounting standards for reporting. Type 4 ICDs, 3 to 6 month duration. A feature of the ICDs. ICDs are not backed by collaterals, making them riskier compared to the other secured forms of debts, and hence they are considered as unsecured. Since they are unsecured and short term, the interest rate obviously offered is obviously higher compared to the traditional bank deposits. Unlike bonds or debentures, ICDs are not traded in the secondary market, and ICDs are bilateral and involve direct lending from one company to another company without intermediaries under private arrangements. Type of ICDs. These can be 3 types. Number 1, short-term ICDs with 30 to 180 days period. Here the purpose is for meeting short-term funding requirement like for working capital. Example is that company using these funds for raw materials and paying it back once the receivables are collected. Number 2 is type 2 is long-term ICDs, that is between 180 days to up to 1 year. These are for longer term investments or funding requirements that do not match typical working capital cycles but still need to be met in the short term. Example is that using these funds for expansion projects or capital expenditures. Type 3 is on-demand ICDs, where the duration, there is no fixed maturity period, and ICDs are repayable on demand by the lender. So on-demand ICDs provide flexibility and can be recalled by the lending company whenever needed. Here example is a parent company lending to a subsidiary company with the flexibility to call back the funds if necessary for its own cash requirements. Operational causes that can adversely impact the reporting of ICDs. Inaccurate disclosures, misclassification of the ICDs, and valuation errors. Ethical causes are including fake FDs and misrepresenting the maturity. Commercial papers, type 5. What are commercial papers? Commercial papers with a maturity of less than 3 months from the balance sheet dates can be qualified as current investment under the current assets. Operational causes that can adversely impact CPs are inaccurate disclosures, misclassifications, and valuation errors. Likewise, ethical causes are including fake commercial papers and misrepresenting the maturity period. Bill discounting by the seller of this of its credit sales. What is bill discounting? Bill discounting is a financial service used by the companies to manage their cash flow, especially after making credit sales. Through bill discounting, through bill discounting, a company can sell its receivables in the form of bills to a financial institute at a discount and then receive immediate funds before the maturity of the bill. Purpose of bill discounting: this is to manage the working capital for its supply chain and improve its efficiency, to free up the cash flow from the credit sales and maintain liquidity, and to fund the ongoing projects without waiting for the customer payments. How does bill discounting work amongst seller, buyer, and the bank or financial institute who discounts these? So, it is important to understand these steps, because any any discontinuity or any problem in this can lead to adverse reporting in the balance sheet. So step number one is sale of goods on credit. The seller company delivers the goods or services to the buyer customer and issues a bill of exchange for payment due at a future date, say 30 days, 60 days, 90 days, and so on and so forth. Submission of the bills. On sale, the seller company gets the invoices endorsed, stamped, and signed by the buyer towards the receipt of the supplies. And thereafter, the seller company submits the bill to the financial institutes like bank or non-banking financial NBFC for discounting. This step number two is very, very important. It's based on my personal experience that sometimes the seller can go to the extent of not getting it stamped from the customer toward delivery and then go to the bank and discount it, which is absolutely unethical. Number four, discounting of the bill. The financial institutes assesses the creditworthiness of the buyer, the debtor, and the authenticity of the transaction. This is where the stamping of the receipt of the material by the buyer or the customer is important. Step number five is the financial institution agrees to purchase the bill at a discounted price. The discount represents the interest the institution charges or earns until the bill's due date. Step number six is immediate payment to the seller. Upon approval, the financial institution pays the seller the discounted amount, typically 90-95% of the bill's values, or it could be different, just a figure which I am suggesting, and provided them with the immediate liquidity. Then step 7 is financial institution collects the payment on due date from the buyer, and they need to recover this amount depending on the type of the bill discounting agreement with the recourse or without recourse. Now, with recourse means that if the buyer customer, if defaults in making the payment to the FI, the seller company is liable to make the payment to the financial institute. Settlement of the transactions. Once the buyer customer makes the payment, the financial institute's transaction is complete, and the seller company can use the liquidity to manage the working capital. So, it is very highly desirable that the transactions are with recourse, though a bit costly, but it avoids the risk. Operational causes that can adversely impact the reporting of ICDs. Improper classification. Companies might incorrectly classify discounted bills receivable held for a short period as a current investment, even if hold period is insignificant. Incomplete disclosures, insufficient disclosure regarding the extent of the bill discounting activity. Valuation errors, incorrect reporting of the face value. Ethical causes are fictitious bill discounting, which I talked earlier, and hidden costs, intentionally omitting disclosure of financing costs associated with the bill discounting. Future references. Building on the Profitability and Ethics, my second book was released in November 23, and this blog focuses on the 6 types of current investment in the balance sheet. Soon I will be coming with my third book, which will dive deeper into the innovative balance sheet strategies and ethical practices that can unlock profitability. You can also refer to some articles of your interest in my website and Facebook and LinkedIn. Thank you very much.